camera, action.
Welcome to Idea to IPO. Hello, everyone. I'm Jennifer Stowell, and thanks to Idea to IPO, these tech startup events in Silicon Valley have been occurring for many, many years. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 150,000 members among all of our meetup groups all around the world. We have organized, promoted, and produced over 2,591 events. By any standard, by any measure, we are the most active, most prolific startup event organization in the history of Silicon Valley, bar none. We organize venture capital panels, legal workshops, and more. These days, we are 100% online. We hold an event nearly every day of the week. Check out our schedule at idea2ipo.com. Our featured speaker today is Roger Royce, and he is one of the top venture capital attorneys in Silicon Valley. And he is passionate about helping entrepreneurs succeed. Ladies and gentlemen, Roger Royce. Roger, take it away.
Okay, thanks very much, Jennifer. Welcome, everybody. My name is Roger Royce. I'm a partner with the law firm of Haynes & Boone. I am resident in downtown Palo Alto, where it is cold and rainy today, but we are in the heart of Silicon Valley. I am in the Emerging Growth and Venture Capital Group at Haynes & Boone. And first of all, I want to thank Rob and Idea to IPO for hosting this event. Let me spotlight this. Hosting this event and making this possible. So tonight we are going to talk about how to prepare your startup for venture capital investment. Now, my practice is primarily technology startups. I represent a few venture funds once in a while, but usually I'm on the company side. And I get companies from a very early stage, sometimes from an idea, oftentimes from a dorm room right down the road. And I take them from very early stage, from that idea all the way to exit if I can. And usually there's venture capital along the way if you're an appropriate candidate for venture capital. That's what we're going to talk about here tonight. So I have a few announcements before we get going and while people log in. First of all, first, let me just tell you, we have a chat feature that's been enabled for everybody. So any participant can talk to, any attendee can talk to any other attendee. So think of this as much as like a real event as possible. In the old days, which was like a year ago, we used to get together in person at live events. You could hand your business card out. I haven't seen a business card in about a year now, I think. But you could hand your business card to people. You can tell them who you are and what you did. Kind of use the chat room to be your virtual business card if you want to talk to people. I'm going to be posting my information in the chat room in a little bit. Tonight, if you're tweeting on Twitter, use the hashtag idea to IPO. I'm going to circulate that in a little bit. And go ahead and tweet if you hear something you like, something you don't like, or if you just feel bored and want to tweet. Now, you will be getting a copy of the slides and a recording. This is being recorded. You will get a copy of the slides and a recording when this is finished, probably within a couple or a few days. You can access my YouTube channel. It's called Roger Royce Law if you want to see a recording of this event, as well as about 100 other ones on various topics, most of them related to startups, some to the business side, some to the legal side. Today, we're going to talk about the venture capital side. All right, people are still joining, so I'm going to keep talking until everybody's here, and then I'll start with the substantive content. There is a chat box at the bottom. Use the chat box to talk to me, to talk to your friends, talk to the other attendees, tell me if something's wrong. Use the Q&A box if you want to ask questions. I'm going to talk for 1 hour from 7 Pacific to 8 Pacific, and then from 8 till 8:30 Pacific, I'm going to take questions. So put your questions in the Q&A box. I'll get to them at the end of the formal presentation. Now, before we get going, I would like to start with a poll. So I'd like to know who is in the audience. Who do we have here tonight? Are you a startup entrepreneur? Or are you from maybe a more established, older company? Are you an investor? Are you a service provider? Any VCs out there, any academia, government, or even media? I'm going to leave this open for 1 minute so I can get, so far, almost everybody here is a startup entrepreneur. Not exactly everybody, but most people. Looks like we have some investors in the audience. That's good. You'll want to chat to them. You know who they are. But boy, but 80% startup entrepreneurs. How about that? I'll leave it open for a few more seconds. We do these events. Rob does these events every day, of course. You'll see me about twice a month talking about various topics related to startups, to venture capital, to the legal issues, especially in the United States around these sorts of things. We did an event a while back on fund formation even. So we do events on lots of different topics. You'll see these periodically. Okay, I've gone past my minute. And we've got 80% startups and kind of a handful of everything else. So I'm going to end that poll, but I am not done asking you questions. You'll get your chance to ask me questions later, but now I get to ask questions. And my next question is, where are you all from? I am sitting here in Palo Alto, California, heart of Silicon Valley, but I am very curious as to where you folks are from. So are you from Silicon Valley? Are you from North America, someplace else? Anyone from Asia? We've got people from Western Europe, even though it's the middle of the night. Okay, so we got the insomniacs here. We got no one from Eastern Europe yet. How about Latin and South America, South Pacific, Africa? We've got someone from Africa. Other, I don't know, what is other? Is that Antarctica, maybe? I don't know. I'm trying to cover the whole world with this poll, but I never quite do. So far about 40% Silicon Valley, about 40% other parts of North America, 11% Asia. And then we've got someone from Africa and wow, quite a few people are other. Okay, I'm going to refine that poll for next time. And that is the end of the polling. It was a tight race, but Silicon Valley won out in terms of where are people from. All right, and then the last thing before we get going, we just yesterday, in fact, or Sunday, formed a Startup Solutions LinkedIn group. So it's a place where we can share content related to startups. Please join my LinkedIn group. You can find me on LinkedIn. There's my profile. You can find my YouTube channel, and you can follow me on Twitter. You got all the links right there to use at your leisure. Now I'm going to come to the most technically difficult part of the program, and that is the sharing of the screen portion. So somebody chat me and tell me that you can see my slides. All right, let's see here. Whoever chats me and says they can see my slides gets a free copy of my book. Oh, here we go. Yes. All right. Awesome. Awesome. Okay. How to prepare your startup for venture capital investment. The first thing, oops, I guess I'd like to mention is that I am a lawyer, so I got to give you a disclaimer. Whoops, it's not changing, is it? Give me a second here. You should see a slide that says disclaimer on it. And that's not happening, is it? Okay, how about now? Do you see disclaimer on your slide? Let's see if that works. Okay, this is not legal advice. I'm just talking about how to get venture capital. I'm a lawyer, not your lawyer. I could be your lawyer. Just give me a call and we'll set something up. So the first thing I'd like to talk about is sources of funding. So you should see a slide on your screen that says sources of funding. Sorry to do this, but I want to make sure that I don't get too far into this. You see a slide that says sources of funding. Somebody chat me. Disclaimer still. All right. Okay. Well, keep an eye on me here. So sources of funding, you're a startup company. Most of you are, 80% of you are. I want to talk, before I get into the venture side of this, I just want to mention, there's a little bit of a long road to venture. Not a lot of companies will end up going to venture capital immediately right off the bat, right? Most companies will get some money from their founders, first of all. So the founders are going to have some skin in the game. We'll talk about how much that is in a minute here, but let's just go through the sources first. Founder money, debt financing, if you can get it. Venture-backed companies are typically not good candidates for debt. If you got cash flow and you can get debt, then you don't want venture. Government grants, it's hard money to get, by the way, but it is out there. Friends and family, pretty much everybody does that. Angel and seed investors, before we get to the venture capitalists, we'll do the angel investor and institutional or venture capital money. So we're not going to talk about this, but I want to let you know that there is such a thing as crowdfunding, rewards-based, that's Kickstarter, etc. And then there is crowd financing, which is a lot like Kickstarter, but for financing. In 2012, we got the Jobs Act. By the way, I just gave a quote to a reporter this week about the Jobs Act and how it's worked out the last 9 years. And the reason why is because for the last 9 years, under what they call Reg CF, you could raise up to 1 million, a little more than $1 million through these CF fundings where you didn't have to have accredited only investors. We'll talk about that later in the presentation. I just want to alert you now that that cap is now about to be raised to $5 million. So Jobs Act financing is going to be a real alternative to venture capital. I think it never really was in the past. $1 million is not a venture round. 5 million is a small venture round, but you're still getting into venture territory at that level. So now we got Jobs Act financing for that as well. ICOs, STOs, IEOs, we've done presentations on those before. We won't do any more of those tonight. And then royalty financing, which is about to become the next big thing. And hopefully I can get to that by the end of this presentation. Okay, top funding sources. Chat me if you don't see top funding sources. All right, top funding sources. Where does most of the money come for startups early on? Will be personal money by far. Founders put a lot of money into their own companies. I'm closely following and related to that is going to be friends and family, of course. After that, venture capital is right about the same as angel investment money, just generally speaking. And it might be even more than that these days because, there's so much easier to get angel money now. You've got crowdfunding sites, you've got basically online VCs. So angel and venture are pretty close. Banks, not so much for my clients. My clients tend to be venture-backed companies. And then finally, as we talked about, crowdfunding. So regarding founder money, all right, can everybody see us? Sorry, I'm having so much trouble with the slides here. All right, I'm gonna make an adjustment here. I'm gonna close one screen. All righty. This will make it easier. I got too many screens open. %7% of founders startups rely on the savings of their founders for their first money. That's a lot. That's almost everybody. Now, what I want to caution you about is that you definitely want to have some of your own money, your own skin in the game if you do this. On the other hand, I'm a lawyer, therefore I'm risk averse, and I tend to be pretty conservative about this. So I tell people, yes, you should have your own money in the company, but not so much that you're going to do anything crazy. Okay. And I do have people come to me from time to time and they say things like, gee, I'm going to go mortgage my house, which is the only asset I really own, or I'm going to cash out my IRA or my 401k to launch this company. I will try to talk them out of that. Okay. Yes, you need to have some of your own company in, but it can't be enough to wipe you out. Because I have to tell you, it's like American Idol. It's a minority of startups that are actually going to make it to a liquidity event. So you might not make it on your first try. And you need to accommodate that risk by using other people's money. And that's what we're going to talk about tonight, because in case something goes wrong with your first effort, you definitely want to be able to live to start again. Nevertheless, it helps to have some of your own money in. Who else is going to finance you early on? Maybe you can get debt financing from a bank. But like I said, if you've got cash flow, and you need cash flow to get debt financing, right? You got to have cash flow. Where does that come from? It comes from revenue, not only revenue, but probably EBITDA, that's earnings. You have to have cash flow to be able to service debt. If you're the kind of company that's got EBITDA that generates cash flow, you might not be on that track for venture. Venture-backed companies, venture capitalists, believe it or not, would rather you not have income and EBITDA. They want you spending that money, not paying taxes on it. They want you reinvesting it in the company and building up the huge goodwill asset that's going to generate the big exit for them. So if, however, you do get debt financing, maybe on the strength of your own personal balance sheet, you are likely in a startup to sign a personal guarantee. We've got a whole program we do on startups in the down economy where I try to talk people out of that because you can get called on that guarantee if things go wrong, but just expect that to be the case if you're going to get that kind of money. Here's a couple of websites. If you want to do government grants, we could do an hour on government grants. At a high level, what I will tell you about government grants is that it's a lot of work. Okay, it's a lot of work. And there are people out there that do this for a living. They do it very well, and they can help you with this. I'm not going to talk about government grants here tonight. There is a lot of grant money available. Again, our other session, Startups in the Down Economy, we talk about some of those sources, especially if you're an ESG company, if you're doing something in energy, agriculture, or some, especially now, probably under the new administration, there may be more grant money available. Okay, hang in there. We're coming to the venture part of the program soon, but before we get there, I want to talk about friends and family money. 38% of startup founders raise money from friends and family. Okay, that's your rich uncle. That's people that will gamble on you based on the strength of your PowerPoint. This is before you have traction. You might have proof of concept, you might not, but you're going to go to people that are going to, that first of all, can afford to lose a little money, and secondly, are willing to fund your idea because you might have the next big thing. It's not very much money, okay? Not very much money is friends and family. Just keep that in mind. If you're asking for a lot of money from your friends and family, they're not going to be friends very long, and I don't know about family. I guess I can't do anything about that. Angels. So I grouped them into three categories. Angels are high net worth individuals who will help fund companies. And there was a time when angels did not need to see any traction. They needed to see proof of concept, meaning you had to show them you had something. Maybe it was a beta, maybe it was a product. They didn't have to see that you could actually sell it. These days here in Silicon Valley, angels have become more like little VCs, and a lot of them want to see a little bit further down the road towards traction. But for our purposes, we're going to say an angel is going to be someone who's going to fund you before you even get there. High net worth individuals, okay, they will do a lot less due diligence than a VC. They'll take a lot more risk. That is not to say none. If any of you have read Jason Calacanis's book, Angel, you will find out that there are some angels out there, very sophisticated angels, who will do quite a lot of due diligence on your company and will, impose a lot of discipline on your company. That's a good thing. Take the pain early if you can. If you got someone that's willing to give that to you, that's a great angel. I tell people that not only do you want money from an angel, the best angels are people that can become advisors as well and can give you some tips and maybe even give you a connection to the VC. The best angels will do that because they feed a steady flow of deal flow to the VCs. Angel groups, there's tons of them. A lot of them here in Silicon Valley where I practice. These are groups of high net worth individuals. They'll get together, they'll listen to your pitch all at once. So you do it one time instead of 20 times. Then they'll get together, maybe they'll pool their money, maybe not, and go ahead and make an investment in your company. Angel funds. This is where we basically formalize that angel group relationship and put it together in a fund. It's still a pooled investment vehicle comprised of all of these angels, but it's still very early stage, right? It's generally, traction is a lot less important. They're willing to gamble on you, and in return, they're getting in at a relatively low valuation. I'll tell you how that works in a minute. Okay, finally, you're here to hear about venture capital, and I'm here to talk to you about venture capital. So let's talk about venture capital. There's a picture of a venture capitalist. Okay, actually not. Some of my best friends are venture capitalists. They don't all look like that. Some of them do. I'm going to tell you how to avoid those ones and deal with the good ones. Before we do that, why should you care? Why are we even talking about this? Why is this a thing? I want to give you some numbers. This is from the Pricewaterhouse CB Insights Money Tree. 2020 was actually, despite the pandemic, a big year in venture, okay? A very big year, $130 billion. Venture did just fine. There's tons of money out there. There's tons of money, not only in venture, but a lot of other places, but also in venture capital. And that money has to find a place to go. For the first time ever last year, I saw local venture capitalists funding companies that are not in Silicon Valley. So for those of you who are not in that 76% that are in, that 38% that are in Silicon Valley, or that other 35% that are in North America, you're in someplace other than that, you can still access Silicon Valley venture capital. For the first time ever, I talked to VCs who funded founders they had never met in person. They met them on Zoom. Some of them are regretting it. They wish they'd had gone out and had a beer with them and found out what they're like. But nevertheless, they're forced to do business that way because they have to spend that money. All right, it's not quite use it or lose it, but it's sort of like that because venture funds have a life and they have to deploy their capital over that lifetime. And if you can only meet people on Zoom because of the sheltering or whatever, it doesn't really matter, does it, if they're down the street or on the other side of the globe to some extent. And that's what the data has showed. Big year for venture. How about 2021? What do you think is going to happen in 2021? Well, this came out just today on Crunchbase News. February was almost a record of investment in startups. So it just keeps getting bigger and bigger and bigger, it says, it seems. I'll give you some more Crunchbase statistics. This is just today on Crunchbase. I read this. Global funding by month, just look how strong it's been. And it seems to be getting better. I mean, it's a little off from January, but still a big month nonetheless. Rounds above 100 million and above, if you're at that stage, these are probably good times. By the way, the trends show that most venture is going into later stage funds. Remember that thing I told you about meeting founders on Zoom and that pandemic? Well, a lot of VCs are feeling a little nervous about that. So they're saving their investment to do follow-on rounds in existing companies rather than funding new companies. At least that's what the data says. Anecdotally, you might find something different. 22 new unicorns in February. These are companies that raise money at more than $1 billion valuation. Just look at them all. Just look at them all. Okay. So this is big time for valuations. It's not just Bitcoin that's going crazy in value. It seems to be startup company stock as well. By the way, take a look at where the lead investors are from. Right. Palo Alto, San Francisco, Palo Alto. So a lot of them are still located right here. Redwood City, Andreessen was in Menlo. I guess they moved. But you'll see there's VCs from all around the world that have gotten active in the bigger rounds at the later stages. Acquisitions. Why do VCs invest? They invest for liquidity in the back end. Again, I do a lot of M&A work myself, and I can tell you that deal activity is very high and very strong. We're seeing a lot of acquisitions. And this excludes companies that went public. It's down a little bit, but it's still pretty strong, based on historical numbers. And then IPOs, it's, and this excludes SPACs, which maybe we'll talk about later, but IPO market seems to be strong as well throughout the world. Okay, now let's talk about you. Since now we talked about what's going on in the market. So the first question you should ask before you even get here is, should you even take venture capital? Are you a good candidate for venture capital? That's the number one question. And you need to consider a few things. I tell people that even though this is what I do for a living, I still tell people venture is really in a way, it's funding of last resort. I mean, it's the funding you get if you can't borrow money. It's funding you need if you can't fund through operations. And the reason why is a couple things. Number one, it's very expensive. You have to give up equity, very risky for the investor, that is. It's also risky for you. I'm going to tell you why in a minute. It's really only suitable for the type of company that can scale and become huge. All those numbers I just showed you, you didn't see any small numbers there. Nobody cares about small numbers. Nobody cares about, just getting their money back or getting an 8% return or a coupon. They need big multiples, big home runs. So if you're not that kind of company that has the potential to be $1 billion exit, or at least more than $100 million exit, don't even bother. You're in the wrong business. Now, you can make yourself into that kind of company by redefining your market. There's a lot of companies that have done that, but you need to be able to show a VC a humongous potential exit. All right. Think about some of the famous VCs and the things they invest in. I was just talking to somebody the other day about Skype. That was a crazy risky investment on the front end, right? But it produced huge returns. That's way back when. I don't know why I thought of that one. There's plenty of better examples since then. But you think about the companies that have produced the hugest returns. They've been the riskiest, the most innovative, the most far out that you couldn't have imagined 10 years ago that we would even have. Self-driving cars, Uber, Airbnb, everything. So it's that kind of company. It's got to have explosive growth. It's got to have a huge market. So if you're that kind of company, you should stick with me here. Now, if you are preparing for venture capital, the first thing you should do is sort of get inside the VC's head and understand what they're thinking about and what they're looking for. And the first place to start is what kind of pressure they're under and what venture capital economics look like from their standpoint. So their fund is going to last 7 to 10 years. All right, that's a fun term. So on average, you might have 5 years left from the time they invest till the time they hope you hit an exit, because their fund has to wrap up at some point on average. It's a fair question to ask what stage of the fund they're in when you go and talk to them. Because if they're later stage and they're making a new investment, they might be tugging on your coattails in a couple of years, wanting you to exit when you might not want to. Keep that in mind. It's worth knowing. Here's why they need such a huge return. Their LPs, so venture capitals are pooled investment vehicles, right? They get money from someone else, they pool the money, they make an investment. We all know that. What do their LPs want? Well, they want 3 times their money back. It's a hugely risky investment. It's a very risky investment for an LP to invest in a VC, so they want a commensurately big return. I won't go through all the math, but I have it on good authority that the fund itself is going to have to earn 3 to 4 times its investment after it pays management fees, after it pays 2% a year. Over 10 years is 20%. It's a big number. After they pay their carried interest, by the way, it could be 2.5% on smaller funds. So the VC is going to have to earn 3 to 4 times their investment to get their LPs what they want. Now, how do they do that? Well, statistically, about 50%, about half the investments are going to break even or lose money. Okay, that's what we just expect to happen. Another 20 to 30%, they're going to do okay, but they're not going to be 3 to 4 times. So that means the rest of them have to be what we call home runs. They have to return 10 times to even 100 times their investment. So the way it was expressed in one popular book on the subject is that, look, if you're a VC and you invest in a company and it returns 100 times your money on that investment, and keep in mind, VC can only make so many investments, not a hedge fund, right? The VC has to be very actively involved in the investment. They typically take board seats, they sit on your board, they spend a lot of time with you, they do their diligence, they have to know your industry, they're helping to get you to that liquidity event. That's why you take VC money. So they can only make so many investments. Suppose they only make 10 in their fund, maybe they make 20. Well, if the first one they make returns 100 times their money, here's the question: how much do they have to make in all the rest of them? And the answer is, get your calculators out and then your slide rules. Anyone even use those anymore? The answer is it doesn't matter. It doesn't matter. They'll make their fund on that one investment. And that's what they're really, really looking for. They're not looking for singles or doubles, certainly not looking to lose money. So they're really looking for something big. So, be something big if you're at least have that as part of your plan or that possibility if you're going out to talk to a VC. Next thing I'd like to talk about, okay, we kind of know what you're about. We know what the VCs are thinking in terms of economics. So are you a good fit for the venture capitalists? Okay, number one, there really has to be a large market. Now notice how I put in italicized letters, potential market, because think about some of the biggest, baddest, like even the companies I just showed you, the unicorns and decacorns I just put on the screen, they're in industries that didn't even exist a few years ago. How would you talk, for example, if today you're going to go talk somebody into investing in your flying cars, which is a thing, by the way, that's a market that doesn't exist. So how can you say, gee, this is a huge market, invest in it? It's not, it's a zero market right now. We may never have flying cars because it's a heavily regulated industry. I think someday we will, but you have to show them that there's a large potential market if there's not a large actual market. And in fact, if you think about it, some of the biggest, successes have been in large potential markets. They've been so disruptive and so different that they were able to show large potential markets. And the people that did the pitch decks were able to make that case. First mover or first to market advantage is very important, not essential. We see a lot of companies. We're talking to you on one right now that was not the first person in the market, but they certainly seem to have been the most successful. But it certainly helps if you can say, look, it's really important we get this money so that we get into the market first and take the space. I hear that all day, every day. That's what everybody wants to do. And sometimes it's taking the space away from somebody else. It's not doing it as well as you could have. But oftentimes, first mover and first to market is key to a company's success when you're talking to a VC. Because remember what I said, keep in mind, it's very expensive money, right? You're taking it because you have to grow fast and you're willing to give up a lot of equity to do that. Well, that's first mover, first market. Now, if you have questions, go ahead and put them in the Q&A box. I'm going to get to the questions at the end of the presentation here. If you have anything else, go ahead and put those in the chat box. Again, I said you're not a candidate for venture for a lot of reasons. If you can actually borrow money to finance your operations, debt is so much cheaper. You get a tax deduction when you pay the interest on the debt, subject to limitations these days. But more importantly, and this is kind of counterintuitive, I look at it from the other way. If you're able to pay debt, again, that means you've got cash flow. That means you've got earnings. That means you're making money instead of building a goodwill asset. And it's just not, I'm not saying that profitable companies can't get financed. It's just not the typical model I think of when I see companies going out for venture. And then finally, I put an asterisk, traction, exclamation point, because the VCs for sure, again, there's exceptions that prove all the rules. But boy, as a general rule, you really want to show them that somebody is willing to pay for your product. And it doesn't have to be a lot of people. It doesn't have to be a lot. But I see a lot of companies that say, look, we're in all these markets. We've got all these users. Well, yeah, but are they paying for your service, or did you just give it to them so you can, get into the market? Nothing wrong with that. If that's part of your go-to-market, then go for it. But before you go to the VC, you're going to have to prove them that people are going to pay for it. And like I say, not a lot. Maybe they buy one. In fact, about 10 years ago, I sat in a meeting with a company. I actually represented the VC on that deal. And the VC said, so it was a software product. I don't want to tell you any more details. Let's just leave it at that, a software product. And the investor said, well, so how many of these, how many customers do you have? And the founder, just kind of sheepishly said, well, we don't have very many. We have sold a few, but not very many. And the VC said, well, do you have 10 customers? Have you sold 10? And founder says, yes. And he said, well, that's good, because if you can sell 10, I think you can sell 100. If you can sell 100, I think you can scale to 1,000, then we got something. Seemed like the dumbest thing I'd ever heard at the time, but here we are 10 years later, and that company is a unicorn. He was right, I was wrong. That's why I'm a lawyer, not a client, okay, for things like that. So just make sure that you can show that you get traction, and because of that traction, you can scale. little bit more about economics. Your VC is going to want to participate in management. Okay. They're going to want a board seat typically. If they don't get a board seat, they're going to get what's called a board observer role. And we'll talk about, I'm not going to talk about management rights letter. That's a lawyerly thing that we lawyers have to know about. You don't really need to at this stage. What you do need to know is that a board of directors, a board seat is way different than an observer. If someone's on your board, that means they have a role in the operations of your business. And that's everything. That's strategy, that's day-to-day operations. They have a role in that. That's structure, that's granting equity, that's all of that. VCs are going to want that. They're very hands-on. They're going to take part in managing the company. It's heavily negotiated sometimes, although it's sort of standard in my business, and I'll tell you more about those terms later, but just be prepared for that. You're going to have good governance forced upon you. If you take venture capital, it'd be good to get into that habit early on. That's what I say. Have a good board, do board meetings, take minutes, have your lawyer come to the board meeting, and help you with those minutes. Have indemnity agreements, get D&O insurance, do all that stuff, be advised on stuff. Have a professional help you with the minutes. By the way, practice pointer, I don't think I've ever seen anybody get this right. You have to be sued before you get this right. Minutes are way more brief than you think they are. Right? I know that every company, it seems, somebody gets appointed to take the minutes and they write War and Peace after the first meeting, and they feel so proud of themselves, they want a pat on the head for taking down every last detail. I'm not joking. I've seen minutes that say, and then so-and-so got up to go to the bathroom. I'm not making this up. Okay, that is absolutely the wrong way to take minutes. Minutes are only there to prove that you had a meeting, you considered an issue, you took action. That's what you need to do to satisfy your fiduciary standards. They're not there to give some litigator down the road a roadmap to say, aha, so you were in the bathroom at the time that they discussed this issue and you didn't understand what you were doing. Isn't that true? You don't want to be in that position. Minutes have to be brief. Minute writing is an art. It is an art. And it's just very few people I've seen that get this other than trial by fire, having done it for a long time and then watching the stuff that you drafted get drug in front of a jury or a judge, as I have many times, and they sit there and analyze it and see if there's anything they can make hay out of. So, be careful about minutes, get professional advice. They're a lot more pithy than you think they should be. Okay, end of sidebar. Venture capital economics, as we said, the term of the VC fund is 7 to 10 years and sometimes longer because they have extensions these days. Just keep that in mind. It's fair game to ask your VC, where are you? I mean, how old's your fund? How long are you going to be around? Another war story. I had a client that took venture money from a VC that had 4 years left in its term. And that was 4 years right before the worst recession that we've had in the last 20 years. It didn't matter. End of my term, I need an exit. I don't want to sit around and babysit you guys forever. So I'm on your board. I insist you put this company on the auction block and sell it. And they sold it at a dirt cheap price. Founders didn't, they made a little money, but nothing like they could have. They sold it at a dip in the market. It was just bad timing. Just keep that in mind. How long do you need to execute on your plan and to have that big bad IPO or M&A transaction? And by the way, it doesn't always happen like that. The VC can do a secondary. There's other ways to deal with this problem. I just want you to be aware of it. I'm not saying it's insurmountable. And then finally, because VCs have to participate in management, go to board meetings, get on planes, do Zoom calls, they don't make small investments. And more importantly, I should put another bullet point here, because they have to have big exits. They can't do that with small investments, right? A $10 million exit, $10 million to a VC doesn't move the needle for most of them. So they have to make bigger bets, and that makes bigger investments and fewer investments, just in order to get the kind of returns that they need. It's not a hedge fund. Just keep that in mind. All right, what's the VC looking for when they come to talk to you? What do they need from you? So number one, I hear this all the time, all day long, every day. I've heard it for 30 years now. Oh, it's all about the people. We're in a people business. VC equals people business. It's team. And I believe that's true. I think team is super important. And some of them, it's more important than others. I've heard the folks at Draper Fisher talk about team quite a lot. They're very much on who are they investing in. What does that mean exactly? And why is that so important? And what do you mean by team? Well, for me to break it down, I think domain expertise is super important. And if you don't have it in your team, you better go get it, either through a founder or through some advisors. By domain expertise, what I mean is if you're building a technology product for financial services, a fintech product, better have somebody on board who understands financial services, right? If you're building something for agriculture, which I do a lot of, an ag tech company, better have someone on board who understands agricultural markets. You're just not going to get very far if you don't. I've seen a lot of companies fail because they figured how tough can it be? We'll just, like any other business, we'll put up a website and the world will be the path through our door. So domain expertise is important. Technical co-founders tend to be important as well. A lot of the VCs I know, they want to know that your co-founder is technical. I think because who else is going to put the blood, sweat, and tears into your company other than a co-founder to build the technology out, right? Now, I know you think you can go out and you can hire that out, you can buy that, you can get that someplace else. Yes, but my experience is that companies with technical co-founders tend to do better. And I know some VCs that say it's just an absolute must or they won't even talk to you. Now, why is this so doggone important? Why is that? Why am I leading with team and spending so much time talking about it? So I want you to get inside the VC's head. You're sitting in that pitch meeting. They're looking at you. They're looking at your idea. And I know you're unique. You're a snowflake. No one's ever thought of this. You have no competitors, and what you're doing is way different. I can promise you that VC is thinking, there's got to be somebody else out there who's thought of this, someone else who's done it, or someone else who could, right? Is this the team that I think can take this idea and take it to market? Or is there another team someplace that can do it better? That's why team is so important. Doesn't necessarily require pedigree. It doesn't necessarily require that you went to some particular school. It does require that you prove to that VC that you're the best possible group of people to take this idea and get it from here to here, from idea to IPO. So that's why team is so important, because the VC, I'm not saying you are replaceable, but the VC is constantly going to be thinking, can I substitute someone else for them to execute on this idea? And don't think they won't, by the way. First of all, they won't sign NDAs, it's non-disclosure agreements. Even if they did, it wouldn't protect you from that. Technology or product. I don't know. Does technology matter? I don't know if it does or not. I see a lot of technologies that seem to do well that are clearly not the best technology. I've been involved in some industries where I've represented competitors and not doing the tech stuff, doing the corporate stuff. And I've been a little surprised at which one won out because I form an opinion as to who's got the better technology. But if you're a tech startup, you certainly have to, I think, meet a base level of technology competence. And what I would leave you with on this point, and this is where I'm probably least expert because I'm not a tech person, is that your technology, who was it? Was it Ben Horowitz or was it Mark Andreessen that said you want to sell aspirin, not vitamin pills, right? You want to address a pain point. I mean, I've gotten up in the middle of the night to take an aspirin. I've never gotten up in the middle of the night to take a vitamin pill, right? You want to solve problems and address pain points. Does your technology or product do that? And secondly, do the customers get it? Will the customers accept it? We're on Zoom right now. I can tell you that I've seen pitches of Zoom so many times, not called Zoom, just other things. Zoom made it, they didn't. Zoom had customer validation, the other ones didn't. I don't know if Zoom's a better technology or not. All I do know is that the idea was out there, and this seems to be one that's winning. And then market size. We talked about this already, so I'm not going to talk about it again. Okay, picking a VC. All right, now I'm going to go way off the reservation here and give you some hints because What's that rule? First of all, never speak ill of a VC. Well, I got to tell you, VCs have reputations. And if they don't, let's give them a reputation by doing business with them and making sure we keep them all honest. But it doesn't take long to ask around and find out. And what do I mean by reputation? Here's what I mean. Are they going to close? Right? If they sign a term sheet with you, are they going to close? Or are they just going to waste your time for 3 months? Well, you could be talking to somebody else and not close. I did a transaction a few years ago. Not going to name names. The VC, really, we negotiated for more than a month. It was heavily negotiated. Every point was hard fought. It was ridiculously heavily negotiated. These things are a little bit more standardized than that. And this went on for more than a month and cost a lot of money. And we got to the day when we finally got agreement on every single term. I sent out signature pages, and at 6 a.m. the next morning, 8 a.m. the next morning, I get an email that says, we changed our mind. We were unable to close. My partners have decided we don't want to make this investment. Okay, I got to tell you something. Nobody that I know is ever going to do business with that VC again. We're not even going to entertain a term sheet. We want nothing to do with it. That is such bad form. I've never heard of another case that egregious. But do your VCs close? So you might want to know that. All right. And you can ask around and you can find out. What stage is the fund at? And what size of the fund? We talked a little bit about that, right? As to where they are in their life, but also what do they invest in? Don't waste your time talking to a late stage fund if you're an early stage company. Just don't do it. Don't waste the time. Unless you just want to get honest feedback for when you later do it. And by the way, some late stage funds will set aside money for early stage companies just so they get a first look and they got a seat at the table and can get in when they do their bigger round. So at least just know about that, know what you're getting into. How much dry powder? What do I mean by that? You might need follow-on money. In fact, I'm pretty sure you are going to. Is this VC going to be someone that can come and make a follow-on investment? If not, because they're just about out of money, so the way VCs work is they take the venture fund, they'll go call capital periodically, and then they have an investment period. And then they have to invest through that investment period. And then for the rest of the fund's term, hopefully they just harvest their gains. So are they at the end of their investment period and have spent all of their money? So they're not going to be able to do your Series B, even though they're getting into Series A. Why might that be an issue for you? Well, it might be an issue because when you go out into the market and the VC for your Series B and the VC that was in your Series A won't do the Series B, that doesn't send a very good message to the market, right? You have to explain that away, right? Now you can explain that, there's good reasons for that. It has nothing to do with the company, but boy, it'd be nice if you could count on them to do the Series B round as well. And if not them, then Fund 2, Fund 3. So most venture capitalists I work with, they're serial fundraisers. They create separate funds. Sometimes the later funds prop up the earlier investments. So just know what you're dealing with. And finally, you won't read this in any book. You'll only hear, are they litigious? My advice to you, especially if you're in California, where any idiot with $2,500 can go down to the courthouse and make your life miserable. Are they litigious? Do they work things out or do they sue people? You don't want to, and that's not just VCs, it's anybody. Just don't do business with litigious people. That's my advice. If they're not willing to just, be adults about it and understand you're going to lose some money once in a while and, walk away, you don't want anything to do with them. That could put you out of the game for the rest of your career. Now, structuring for venture capital. By the way, do you know how do you find out if they're litigious? It's all public record. You can go on to court. You can go online. You can go on. Every county has a court, has a website. Every county court has a website. You can go on. You can do a search, and you can just put in names, and you can find out who you're dealing with. Or you can do background searches. And by the way, the VC is doing a background search on you. You better believe they are. I don't think it's unfair at all for you to do a background search on them, either yourself or through a professional. Background searches are dirt cheap these days online. You can find out a lot about a company. Do your own intelligence. Structuring for VC. Let's talk a little bit about that. And this is going to feed really well into part 2, which we're going to do next week. Business model, we talked a little bit about that already. Choice of entity, we'll talk about cap table vesting and debt. So let's get to it. I've said this so many times before, and I see we have some repeat customers here tonight. I won't spend a lot of time at it other than to say this slide illustrates for me the idea that VCs want to take a lot of risk, right? Which requires a lot of money up front. That's that looks blue to me, that blue or green line, where it dips down at the bottom into generation, development, commercialization. Then you get product launch, but then you get a big upside, right? That's different than the kind of company that maybe doesn't have to put a lot of money into product development or commercialization, but their upside is limited. There's lots of reasons why licensing companies are in the latter category. And I tell the story a lot about companies that I've seen in my career that started out for that nice and easy licensing play because they had a great tech and they knew they could make money licensing without a lot of money up front, and then shifted to being actually the product company. And by the way, it's not just licensing. I've seen companies now, there's some very famous examples out there, I won't mention them because they're clients, that started out being data companies. And then they come to realize, wait a minute, I got all the data. I can just sell the products. What am I doing? Just selling the data. I can make way more money just making and selling the products or delivering the service. So that's a VC play, right? Because that has much higher upside and we don't mind the additional increased costs up front. Choice of entity. I'll make this really short. You're going to be a Delaware C corporation. If you're going for venture capital, you don't have to be one today, but you got to be one by the time you close your venture investment. We could spend hours going through all of these advantages. I'm just going to focus on a couple of them. Which one should I focus on? How about my favorite one? Qualified small business stock. And this is angels, this is founders, this is any individual, including partners in a VC fund. They have the ability to exclude from their taxable income 100% of the gain for federal income tax purposes, 100% of the gain from the sale of the stock they bought in your company. This includes you, the founder, up to $10 million or 10 times your cost basis. Now you have to meet a whole bunch of requirements. And I spend a lot of time these days going through and looking at companies and making sure they met these requirements. But qualified small business stock is a big deal. Everybody knows about it. You have to be a C corporation in order to offer up that benefit. Ever since the corporate tax rates have gone down, this has become sort of a very big thing and maybe the deciding factor. All right. I want to talk a little bit about some of the other things you want to have in order. And we're going to talk more in 2 weeks about when we do part 2 of this presentation on how to position your company for venture capital. But here on the structural part of this, the equity, you got a bunch of founders. The founders are going to have stock. What's that going to look like? So question number 1, you have to figure out how to divide up the stock. We do a whole presentation on this. You'll find a video of it on my YouTube channel if you want to hear it. It's called how to split the pie. How do we divide that stock among the founders? Remember, I said you should have a technical co-founder, right? That implies more than one founder. Sometimes not, but usually yes. So we need to figure out how to divide up the equity, but we got to do it in a way that the VC looks at this and says, yeah, that makes sense. Everybody's properly incentivized. If they don't get that feeling, just keep in mind, there's 99 other companies, that want that money that they can go talk to that maybe does give them that warm, fuzzy feeling that the founders have fairly split up their equity. Secondly, you got to have vesting in place. Here's what I want to say about vesting. And I've said this many times before. 4-year vesting is pretty standard. Sometimes you see 5, oftentimes you see 3. Doesn't matter. The VC is going to make you revest anyway when they invest. They're going to make you sign up again for another vesting schedule. Why is that? Because they need to make sure you stick around long enough for something to happen for them. And so they need, and usually that's going to be 7 years, 7 or 8 years, maybe 10 years. So they're going to need you to unvest and revest and start over with your vesting schedule. For those of you who are wondering what I mean by vesting, go ahead and take a look at our video on vesting. We spent quite a bit of time talking about it in some of our other discussions, how to split the pie. But generally, vesting means you earn into your shares through continued service. So if you've got co-founder who has 3-year vesting and he leaves after 1 year, he keeps 1/3 of his shares and gives 2/3 back. That's the basic idea. It's a lot more complex than that, but that's the general idea. Advisors, I'm a big fan of advisors. I think you should have advisors. I don't think any founding team can do it all. Advisors are people, they're not directors, they're not management, they're not consultants. They come in for very specific targeted purposes. They're going to do a very specific thing for you. You're going to give them a little bit of stock or maybe some options for it. You're going to hold them to their promises with performance metrics, milestones, and deliverables. And then if they achieve what they said, they'll vest and then they'll go away, usually within 2 years, and hopefully come back and get cashed out when you have a big exit that they helped you have. Now, advisors, they just operate on a different kind of level than other folks, than your employees or your founders, because they're so targeted. But when would you use an advisor? Oftentimes, if you don't have the relevant domain expertise and you need someone who's an expert in some little niche thing, you'll get an advisor to help you. I have fintech companies that get advisors who are in banking to let them know what it is that they need to do differently to access those markets. I have a lot of ag tech companies. I have advisors in agriculture. Almost every company will oftentimes could use an advisor who knows something about going out and raising some money. Oftentimes you see advisors on technical issues, things like that. A lot of times you'll see advisors who know the industry, big co, the big potential acquirers. What do we want our company to look like in order to be acquired down the road by that company? I see advisors do that oftentimes from time to time. So how are we going to compensate these people? Like I said, with equity. That could be options. It's usually options, could be restricted stock, could be other ways of doing it. Working on a transaction now, we're using phantom plan units. That's just an incentive bonus. It's a contractual obligation that mimics stock. And so there's various ways to do it. You'll notice I don't have cash on this list. You're a startup company. You need to conserve your cash. You want the advisors to take a lot of risk right along with you. Never do I see an advisor compensated with cash. If they're getting compensated with cash, they're not an advisor, they're a consultant. Whole different category, that we're not going to talk about. Vesting, we talked about. I just want to, as we come to close to a close here, I just want to talk again about the VC's perspective about vesting. And I know I mentioned this, but let me just hammer this home again, because I want you to anticipate this and not be surprised and not look like a rube when this comes up. So you're going to have like maybe 3-year vesting when you start your company, maybe 5, somewhere in there. And that means, gee, I got to stay here 5 years as a founder to keep my stock. If I leave before then, I got to give some of it back at cost to the company. Okay, I can live with that. I think I can stick with this company for 5 years. 3 years later, you go to your venture round. A VC says, wait, you only got 2 more years left on your vesting. That's no good. We want you to stick around. We want you to unvest, right? And 4 years just seems to be like standard. So they'll ask you to restart your clock at close for another 4 or 5 years. Very common, very standard. Just expect it. Don't be surprised by it. And you're better off not trying to fight it, because they're going to need that. They need that to keep you around, because it gets very expensive if you don't have that. If they don't put that vesting restriction in place and the company does an acquisition, that means the acquiring company, they're looking at you and they're saying, we need to keep that guy with us for at least another year or two. If that man or woman, that founder, is fully vested, how are we going to do that? We got to give them some more unvested stock. Makes it very expensive. Where does that stock come from? Comes from out of everybody else's share. So there's good reasons why the investors will ask for this. There's good reasons why you're going to give that to them. Now, it used to be 4 years and out, and you didn't have this problem that, gee, we're being asked to invest. And that's because companies could exit. They could go public in 4 or 5 years. In fact, they all thought they were going to go public in a year. The law changed. Dodd-Frank came along, Enron came along, all of that. A lot of things changed, and companies don't go public that soon. I guess now they're doing SPACs, but we'll see how long that lasts. So most exits are M&A, and they don't happen in 4 years. A lot of them that I do, they do, but overall exits can take a long time. IPOs can certainly take a long time to build up to having the metrics to go public. So just expect that you're going to be vesting for longer than 4 years. It's a long way of saying it's going to take longer than 4 years. And finally, the last thing I'll leave you with, before we get into our questions, Q&A, is the other thing that's been happening is because it takes longer to exit, companies, what they're doing is they're allowing people to extend their option exercise periods. What I mean by that is you have a stock option, that's a right to buy stock in a company at a certain price. And you can exercise that right anytime while you're employed or for usually 90 days after you terminate your employment. Well, 90 days isn't long enough because it's going to be forever before we exit. So companies are saying, oh, we're going to be good guys about it. We're going to give you a year to exercise or maybe longer. I really don't like that. I think it messes up your cap table. I think it's too much overhang. It's too hard to understand exactly what you've got and to plan and project. But nevertheless, that is being done a lot, and the VCs are letting companies get away with it. Okay, now with that, I'm going to exit my sharing and I'm going to go to the Q&A, and we're going to take a few questions. I want to thank you for listening. Sorry about the technical problems. I've tried something new tonight. It didn't work. I won't do that again. All right. Yes, this recording is available later on. You're going to get an email with a link to the recording as well as the slides and an invitation to join my YouTube channel. Here's a question. Should we keep companies in different countries independent or make them branches? Okay, so I think what you're asking, and this is half of my practice, are companies from outside the United States coming into Silicon Valley and into California and into the United States. You've got a company, you've launched in your home country. You've done great, you've done well, right? And you want to now expand worldwide. You want to come to Silicon Valley. You want to access our markets, right? Because all the big companies are here. If they're not headquartered here, they have a substantial presence. You want to access talent. The talent here is really something else. There's so many good people, software, hardware, you name it, they're here. You can access a lot of talent. And thirdly, maybe not least of all, you want to access money because probably 25% to 50% of the venture capital is here. So, so here you are in Silicon Valley, and now you're launching here. So the question is, what do we do? We're a company that's organized under foreign country law, and we're doing business in the US. So first of all, you form a sub, a United States corporation. You don't come in and do business in this country without having a corporate shield for good legal reasons. Secondly, what happens if you want to take money from VCs? Are they going to invest in your foreign corporation? Some of them will. Some of them will put money in Cayman, or they'll put money in Ireland or wherever you are. The ones that have branches in those countries are most likely to. Otherwise, they don't want you to do that. Generally, they want you to be a Delaware C corporation. Well, you're not. You're a foreign company. So what do? What we do is what we call a flip transaction. We form a Delaware corporation, and we have the shareholders of your, your UK company. That's a bad example because that's going to be taxable in the UK. The shareholders of your Singapore company drop the Singapore shares into the Delaware company in exchange for shares of the US company. And now what we've got is a structure where Delaware corporation's on top, operating company in name your foreign country is underneath Delaware corporation. Operating company has all the intellectual property, has all the people, has all the operations. So the investor in the Topco Delaware company has an interest in the whole of the business. That's how you want to do that. What you do not want to do is say, look, we're just going to finance our US subsidiary for a lot of reasons. Number one, the US subsidiary is really a big nothing, right? It's got sales and marketing, maybe a little bit of R&D. There's not enough there to finance. You really want to do the flip structure. Now, I know since I'm going down this rabbit hole, let me come out the other end. What happens if we can't? You just told me that transaction is taxable in places like the UK and France and other countries. What happens if we can't do it because of foreign reasons? Or we made a deal with the government. We took government money in Singapore and they won't let us do an outbound inversion transaction. Well, there are ways around that. Or Canada. I just did this with Canada recently. You'd think Canada would be easy, right? But it's not. Canada, it's like a whole nother country up there. So what do we do? Well, then you can form those parallel companies. And there are structures that can help you navigate the fact that you've got US investors and Canadian investors, US company, Canadian company, but you want to tie their fortunes together. That's all I'm going to say about this now. On one, because it's very complicated, and number two, because most of what I would tell you is proprietary. I thought it up. Okay, what's the next question? Why a good VC fit criterion is not able to service debt? Okay, good question. Let me pause on that. And again, this is not science. This is not even fact. This is my opinion from sitting in 100 board meetings with these guys and doing lots of deals over 35 years. And by the way, I have heard this come out of a VC's mouth. It's here's the dialogue. The founder says, hey, we're doing so well, we can now switch from a freemium model to a premium model, and we can charge people to use our platform, and we'll be profitable this quarter. VC says, are you nuts? We don't want to be profitable. I don't want to pay. We don't want this company to pay taxes. We want you to continue to build your user base and build value. And to finish the diet, what he's thinking is that, and then when you sell your company at this higher value, I'll pay taxes at a lower capital gains rate, if at all, because I got qualified small business stock treatment on the back end. I might not pay taxes at all. So generally, VC-ready startup companies, they're building something. They're not focused on short-term profits. They're focused on long-term value creation, right? And I'm a tax lawyer, so I focus on the tax side of that. But there's really more of a business side to that. You're going to get a much bigger return, after tax, pre-tax, whatever, if you focus on the value creation. That's what VCs do. They're not interested in the small short-term losses. They're interested in the huge wins that build up over a long period of time. Now, what does that have to do with debt versus equity? Well, to take debt and to service debt, I've said it twice before, I'll say it again. You have to have cash flow. To have cash flow, I think that comes from earnings. And to have earnings, you've got taxable income. Now, these are all generalities. There are plenty of companies, you've heard of venture debt. Okay, that's venture capital type companies that take debt that gets converted into VC investment down the road. So those are all generalities. But as far as commercial debt goes, other than venture debt, I would say that they're not good candidates. But again, a company gets late stage enough, they build up enough value. Yeah, sure, it could happen. Just not at the early stages, not where I play most of the time. Okay, we have a question here. It says that 45% of Series A are still convertible notes, 45% equity, 10% safes. Is that a hybrid with follow-on equity or a small investment that has a high share of converted notes? Is it a bad question to ask a VC? Hell, that's a bad question to ask anybody because I don't understand it. Well, what I think you're saying is it? I think I see what you're saying. You're asking whether you can offer a VC a convertible instead of a priced round, I think is what you're asking. And yes, they'll do, we call them bridge rounds sometimes because they're bridges between rounds. But that's not what they want. They want to price the round. That's what a VC does. That's the first time that you're going to take institutional money. That's the first time you're going to value the company. That's the first time you're going to issue equity. That's what a VC will do, typically. Not always. I mean, there's Series Seed and all sorts of stuff. But yeah, the VC does not want convertible notes, and because you're big enough where you can value the company. Why do you use convertible notes? Why do you use safes? You use them because you can't value the company. That's one big reason, right? You're just too early. Well, if you're talking to a VC, you're at a stage when a company is capable of valuation by a professional. So you'll value it and you'll issue preferred stock. Number two, the VC wants a whole list of protections that are not built into a safe or a convertible note. Now they could be, but why would you go to all that trouble when you can just do you can just issue the equity? And I guess thirdly, the VC wants to price the round now. They don't want to miss out on a run up. Say with a convertible note, you're pricing, the note is converting in the safe as well. they're converting at a price determined in the venture round. That's going to be a higher price than today, hopefully, right down the road. The VC does not want his equity at a higher price down the road. They want it at today's valuation because there's enough money they can demand that. We're going to talk all about this next week, how we find a good compromise between those competing concerns of not being able to value the company, but also not for the investor not getting in at too high a valuation. Okay, that was a good question. I'm just kidding you. That's a good question. Since it's only an idea, what mechanism can we use to show that there's a customer out there willing to pay for a product, but we don't have any sales? Well, again, there are exceptions that prove this rule, and believe it or not, there are still companies that will get funded based on a PowerPoint. That still happens. Those tend to be serial entrepreneurs who have done really well in the past and have proven themselves, but that can happen. But as a general rule, I would say you're going to have to go find a customer. So I don't want to name names. I worked with a pretty well-known entrepreneur in the Valley who built his company up from nothing, 0 to 1 and then to 100. It was a software product. They did marketing. It was advertising technology. And I remember somebody asked him on a panel. He said, "Well, how did you get your first money?" And so, well, I had all these customers and I showed traction, blah blah blah. And he said, "Well, how'd you get your first customers?" And he says, "Cold calling." So I think the moral of the story is you just got to go out and do the work, right? You got to do the work. You got to show that you can, you got product market fit, or you got to show that you can prove to the VC or convince a VC you got product market fit or traction, or all the things they want to see. So I have a new technology I use in teaching, and my students love it. It's more like well, I won't say that part, but what kind of traction do I need to convince a VC? So education tech is huge. It's a huge market. It's a huge thing, especially now. Zoom has showed us, or the pandemic, not Zoom, but not even the pandemic, just the sheltering in place rules have showed us how much room there is in education for technology and alternative ways of delivering that content. Now is a great time. What kind of traction? Like I keep saying, you got to show them that people are going to buy this. Again, there are exceptions that prove the rule. You might just wow them with your tech or your idea. Rarely does that happen in my experience. You really got to show them that someone's willing to pay for it. By the way, here's another more opinion than anything else, but kind of common sense. But you can think about it. The VC is probably not your customer, right? This is a good example. I don't know what your ed tech product is, but I'm guessing the VC is not your customer, right? They're not the person sitting in the classroom, or whatever it is that's using your product. Or you're a game company. They're probably not home playing games, right? Or you're a social media platform. They probably don't have time for social media, right? Not all of us can spend all day on Instagram. So keeping that in mind, how do they know that you've got a good idea? Well, either they got kids at home who are always using the product so they can see how good it is, or you're going to have to show them that somebody else will actually buy them, right? So I think customers are really key that way, because the investor is rarely going to be your consumer. Rarely is going to have a good way of knowing that you've got a product people are going to buy. Somebody commented on that last question. I said, you can reach out to potential customers, research about the value of the company. Not a bad idea, do some market research. But, I personally feel that, the proof is in the pudding when people write that check. There's nothing like people paying for it. And by the way, there was a company I worked with 20 years ago. They came up with, on that point, they decided they came up with an idea. It was a touch screen computer. So you didn't need a keyboard, you would just touch the screen. And they did get VC money. And I say it's 20 years ago because no one's made this mistake since. And yeah, they got their venture money, such a great idea. It just made perfect sense. It was so logical. And they built these machines with that VC money. They put it in the stores. They did their big splashy launch and it just fell on its butt. Nobody bought them. No one bought one. They asked everybody in the world about how much they loved their idea, except the customers. So I'll never forget that story. So that's why traction is pretty important. Alrighty. And by the way, if you're on chat and if you've got a comment, you agree with me, you disagree with me, you like me, you don't like me, go ahead and put it on chat and share it with your attendees. I don't mind, it won't bother me a bit. After all, I'm just a lawyer and these are just my opinions. How powerful the board seats, board observers are they in terms of voting and taking a decision? So a board seat is very powerful. If someone sits on your board of directors, that means that they have a right to vote. They can help control the direction and the management of the company. That is a very powerful thing. A board observer sits in the board meetings, but they don't vote, so they don't have a lot of power. We're going to talk a lot more about this in 2 weeks, but that board seat's going to come with a lot of strings when you give that VC the board seat. Post Series A, they're going to have 1 of 3 seats. Typically, 3-member board, the VC will get 1. That's not a majority. They can't make decisions. However, they're going to ask for protective provisions that give them a right to block a lot of other decisions. That's very powerful, and we're going to talk a lot more about that in 2 weeks. All righty, I just accidentally closed my chat box. All right, let me read this question. Boy, I'm an entrepreneur. I got a good technical co-founder with me. Good job. All right, I'm glad you've been coming to my sessions and you decided to do that. However, we're not in agreement on exactly or when we release a product. I'm a perfectionist and an artist, and he doesn't care much about the user experience. Who do I need to add to the team to reconcile the differences and keep my startup in good shape? Wow, so many issues there. I just shudder when I read that, because the first thing you said that scares me is when you say you have a co-founder and you don't agree. I hope you're not a 50-50 company, because if you're a 50-50 company and you have a co-founder you can't agree with, where's my book? Darn it, I don't have a copy of my book. Well, that's what we call dead on arrival. That is, and Rob's going to put the link in the chat box here in a minute here, but that's a deadlock issue. That's a very, very bad place to be. You don't want to be in a position of deadlock. Making a bad decision is better than being deadlocked, not being able to make any decision. So what I would suggest is that you do get that third person on your board. Maybe you bring them in as a co-founder, or you figure out some type of equity split that is not 50-50 so you can resolve it. That gets you past the deadlock issue. Now you got the second issue. You guys ought to be like-minded, okay? You guys, it'd be nice if you were like-minded, because when you go to talk to the investors, they do not want to invest in a team that's fighting. They do not want to invest in a team that doesn't get along. They don't want to invest in a team that doesn't have the vision. So I think you're going to have to come to an agreement on this. Now, with regard to the particular issue that you just mentioned, if you're a perfectionist, well, yes, you have to care about the user experience. You know, obviously, that's why we're on Zoom and we're not on Brand X, who shall remain nameless, that I spent a lot of money with before Zoom. But perfectionism, you know, startup is the wrong place for a perfectionist. I'll just tell you. Reid Hoffman does a whole thing on this in his podcast. What is it? Masters of Scale. And if you haven't heard the Reid Hoffman podcast, Masters of Scale, you need to, as soon as you're done listening to my YouTube videos, go subscribe to that. But you know, you need to release a product a little bit early. You know, release it early, even though it's not perfect, and then get feedback. And then, I mean, this is not law. This is not even business. This is just what Reid Hoffman says. You know, you should be a little embarrassed by your first release. So I'm probably going to go along with your technical co-founder. And by the way, you see even big companies do that. I mean, even my iPhone, there's stuff on here that doesn't work so well because they just had to get the thing out, you know, and they'll fix it in the next iteration. I think, you know, what do they say? The perfect is the enemy of the good, or something like that. I don't know. By the way, the rule is exactly the opposite in the law. I don't release anything unless it's perfect. But for you startups that are out testing the market and trying to get there before anybody else, if you wait till you're perfect, you're never going to be there. Will 220 be a thing of the past with blockchain contracts? Will blockchain make some of the V stuff obsolete? Cool. Yeah, so blockchain is something, I have a lot of companies, I've done a lot with blockchain. I taught a class on blockchain at Stanford Continuing Studies for 2 years. And I just gave a talk to a venture capital firm on blockchain investments and enterprise blockchain in particular, and where it was in 2020 and where we think it's going in 2021. No, it's not a thing of the past. Quite the contrary, especially in enterprise. Big companies in 2020 started actually putting money behind this. We now have this thing called blockchain as a service, where Oracle, Microsoft, Azure, IBM they're offering blockchain solutions. It's coming into the mainstream now. Now keep that separate from crypto. I'm just talking about the blockchain technology, in particular enterprise or permission blockchain. But so much is happening with this. What's not happening is the ICO market. Right, what's not in the United States anyway. Now I know we do have exchanges, and there was talk about ICO started displacing the venture capital community. Didn't happen. Is not going to happen. Certainly not in the U.S. Even though we do have, I think there's about 35 exchanges now in the U.S. that have been authorized by the SEC. The rules just do not accommodate the kind of free trading we all thought we would have by tokenizing securities. And by the way, there was a time when people thought they were going to tokenize venture capital funds. I represented one of those funds, did not do very well. Wozniak started a tried to start a tokenized VC fund, and then changed his mind and went back to a general fund. So I don't think it's going to displace VC investment, certainly not in the United States. But I think the blockchain technology, and by blockchain, I'm not going to talk anymore about this. I could go on all night. I mean distributed ledger. Okay, so there's zero knowledge proofs. There's so many ways we can go with this, but I think the better term now is distributed ledger, because we might not have the kind of consensus mechanisms on the back end that we have in crypto. But nevertheless, we're going to see a lot of blockchain, I think, in the future. And I think you're going to see VCs invest in companies that do that, by the way. Is preferred stock obtained by angels in A or B treated differently at exit than common stock held by the founders? Are preferred holders treated differently if royalties are earned on the technology? Tune in 2 weeks. We're going to talk for like an hour about this. But the answer is yes, they are treated much differently. Much differently. That's why they call it preferred stock. It has preferences. It gets paid first in preference to the common stockholders unless it converts to common. And that's why it is negotiated. These terms are negotiated. And then you say, what if there's royalties earned on the technology? Think of royalties like debt, okay? So it comes ahead of the preferred stock, comes ahead of the common stock. It's debt, it gets paid first. So it's debt, and there better be good, unless you're talking about licensing the technology and getting royalties back. If that's what you mean, then I don't quite understand the question. But we are going to talk about this new thing called royalty financing that a lot of companies are doing now. And I've been working with a VC, by the way, to come up with some standard set of documents for royalty financing. So eventually, I think the VCs, it's a really anachronistic industry. It's really resistant to change and to accepting new things. Sorry to say to my friends out there in the venture community, but I think they are going to, at some point, embrace royalty financing. Right now, it looks a lot like debt. And we're going to talk about that next week. Maybe we'll do a whole session on it, because I think that's going to be the next big thing. Top 10 list for preparing for due diligence. We'll talk about that next week. How's that? However, since you asked, let's see if I can rattle a few off the top of my head without looking at any slides. At no time will my hands leave my arms. Number one is capitalization. You got to get the capitalization right. And you'd be surprised how many companies don't have that right. And by the way, there's no shame in that. There are hardly any cap tables are right if you're keeping them on Excel by yourself. And even if you're on a commercial service, it's impossible not to have disagreements about capitalization. Oh, you didn't convert me at the right number. I should have had more interest, more shares for more interest, or whatever. So you just try to get as close as you can. So that's number one. Intellectual property. Do you have rights in your IP? Do you really own it? Did you lose your trade secrets because you were sloppy about it? That's a bad one. That's a huge due diligence list. Employment type issues, especially if you're in California, an employment law claim will kill your company. It'll kill your company. Even venture capital companies. HomeJoy took 40 million in venture capital, went down in flames to employment claims litigation. What are some others? Tax. Sometimes people mess up on this. Data. Now we'd want to get that right. Regulatory compliance. That's only about 6. That's all I can think of off the top of my head. How important to have a valuation before talking to VCs will not help you one little bit, not one little bit. They're going to tell you what they think your value is. Again, we're going to cover this in 2 weeks. If they do ask you what your valuation is, sometimes they will, not very often. If they say, what do you think you're worth? Just remember 2 things. Number one, whatever number you give them, we're probably going to cut in half when they make their counter offer. Number 2, you got to be able to support your number. And you can support it by finding a few different valuation methods that VCs regularly use that converge on one number. I've identified about 30 of them. We're going to talk about it next week. It's also going to be explained in my new book that'll be coming out, God, I hope this year. If Rob gives me a break one of these weekends, I'm going to finish writing it. What are your thoughts? The founders are not technical, but they have a platform and have an advisor who is technical. That might work, depends on your company. How important is it you have a platform? How important is it? How revolutionary, how disruptive is the technology? I work with tech startups mostly, not exclusively, but mostly. For those guys, I shouldn't say guys, for those founders, a technical founder is really important because someone's got to be there to continue to build it out after the investment, and probably has to be there even after they get acquired because it's continued to build. Like Zoom as an example, they just released upgrades that make their platform more secure. They just did that. After all this time, as successful as it is, they're still upgrading. So I think it depends on the company. For a lot of companies, you can get away with a technical advisor, depending on what you're doing. Someone asked me to share the past meetings. You can find them on my YouTube channel. I posted in the chat box where you can get them. At what stage of a startup is it appropriate to have a lawyer on board? Well, I would say at any stage. I asked due to the high cost of having a paid professional legal advice. Yeah, the high cost is going to be, listen to my top 10 legal mistakes to avoid. The high cost is not having legal advice and managing to negotiate every other hurdle that your startup has to get over and then to fall apart on the back end because you messed up on some legal thing because you downloaded a form online that didn't quite work. Those of us who do startup company law, especially here in Silicon Valley, we're startup friendly. And not just me, but almost any lawyer who does this here in this valley, we'll work with you. We'll make it easy on you. We want you to succeed. And the more we'll work with you depends on how much we believe in you. So we just put it that way. I tell my venture capital clients, if any of them are still talking to me after tonight, that I'm as much of a VC as they are. I have to pick winners just like they do because I don't make any money on the front end. I promise you I don't. My companies have to get big and they have to get bad. They have to become unicorns and decacorns, and I do have a few. And then they have to keep me on board as their lawyer. So I make bets just like VCs do. And startup company lawyers know this and will work with you. I want to open, how much time we got? Okay, 2 more minutes. I want to open a company in Delaware and my operations are in Africa. Is it possible to find investors in the US interested to take it in? Yeah, absolutely. In fact, now is probably a good time, depending on what your company is doing. But I see lots of companies, and it's not so much where your business is, it's where the management is located and where the rights are. And it used to be that you had to be in Silicon Valley to get a Silicon Valley VC because the VC wanted to get in his car and drive 2 blocks to come visit you, or not have to go across town for board meetings and not have to drive to Stockton or wherever. These days, not so much. So yeah, it's very possible. Although a little hint here, I think I would test the water before I form that Delaware company, unless you're actually going to do business here in the US. But if you got the right company, yeah, a lot of new technology gets deployed in that area. I mean, I can blockchain for supply chain for agriculture, for example. That's where it's happening. A lot of the irrigation, arid tech is happening in that area. So I think, I don't know what your company does. If you got the right company, maybe. I'm sorry, I am not going to get through all these questions tonight, but I promise you, if you want to follow up with me by email, that I'll do my best to talk with you one-on-one about this. So I'm going to give you my email address. If I can type anymore. Oh, I fat fingered it, sorry. Okay, there we go. And I just sent it to Rob. After all that typing, I sent it to the wrong person. There, that's how you can find me. I'm sorry that I was not able to get to all of your questions. These are great questions. You've been a great audience because I normally get lots of good questions, but normally I get through them all. I couldn't even get through them all today. You asked so many good questions. That kept me talking. Thank you for that. It makes me feel good when people are paying attention and listening. I really appreciate you being here. I want to thank Idea to IPO for hosting me here tonight. Thank you, Rob. Thank you, attendees. Thank you for listening, and we will see you next time.